My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job, not just entertain, but put it in context. Explain it to you. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. When you're trying to get your arms around the market's next move, you got to look at the leadership, meaning what's been working day in and day out. And that's how you can figure out how to make money at this moment. And on a day where the Dow gained 172 points, the S&P was basically unhinged, NASDAQ dipped 0.18%, it might surprise you to learn that there's an index that's been burning like a house on fire. It's a strange index. It's pointing the way. It's the Dow Jones Utility Average, or the Utes, as they are known on the street. The Utes, which rallied 5 points or 0.5% today. Still one more powerful session for the smoking amalgam of 15 utility stocks that dates back to 1929. Yep, this trailblazer started separating itself from the pack back on April 16th of this year. You know what? This seems been almost straight up ever since. The utilities perform best when the economy's throttling back. If this index were just up for a week or even 2 weeks, I might ignore it. But for the Utes to rally this long, sorry, it is flashing red for the economy, telling us we're headed into the shoals of a slowdown. Makes sense. We've been finding those brown shoots I talk about all over the place this month. Brown shoots being my term for companies with fading prospects. When you notice one of these index C changes like I'm talking about, you got to head right to the Wall Street Journal's archives to identify the proximate cause of this new leadership. Oh, this one wasn't hard to find. The headline from April 16th says it all. Powell dials back expectations on rate cuts. And then right underneath, inflation and hiring have been firmer than expected this year, weakening the case for preemptive rate reductions. Nick Timros, hey, Fed whisperer. Okay, Powell was signaling a clear shift in the Fed's outlook right there, according to the Journal. This was the fabled higher for longer interview. Not only was the multiple rate cut scenario off the table, but maybe rate cuts are out entirely because Powell now wanted, quote, several more monthly inflation readings to regain the confidence to take rates down. Bingo. We'd known something was afoot ever since we got that very hot 3.8% core inflation number the week before that headline. Talk about a narrative buster. But this was Powell's interview. It was devastating. Devastating because at the time, we still had this host of people who believed the Fed was going to bless us with multiple rate cuts in 2024. Hey, maybe even before we saw genuine weakness in the economy. These people were deluded, but they generally believed the same people were looking for 6 rate cuts in 2024. Oh, boy. When we came in the year. Now, for the last 3 weeks, though, these people have had no more delusions. And that's when the utilities took off. Unfortunately, very unsatisfying kind of leadership. First, utilities have to issue debt all the time just to maintain their operations, let alone expand them. Now they have to spend more than ever because of our electric grids being overtaxed by the creation of endless new data centers. If rates were going higher, their need to borrow would send their stocks down. That's clearly not happening. Second, think about it. You pay your electric bill no matter what, right? It's the only bill you cannot not pay. The opposite of discretionary, which is why those stocks do so well in the slowdown and the discretionary stocks do so poorly. Now, remember, the utilities are leaders, not what we call coincident indicators, but leaders. They tell you what's going to happen. A rally in these stocks almost always means that the economy is weak and interest rates are headed lower. Sure enough, on April 25th, remember these guys were April 16th, on April 25th, long-term rates peaked. Not because of the Fed, but because many a consumer seems to have tapped out. And that was the beginning of the brown shoots. Right there, right then, we started seeing the slowdown that's now bedeviling so many years. It's when we realized that Starbucks and McDonald's had raised prices too high. The travel, so prevalent since COVID ended, had peaked, at least in America. It's when we knew that oil was done going higher, especially now that Israel and Iran seem to have de-escalated. Oil's been inching lower for days. So it makes sense that the utilities are leading the way here. But what more can this leadership group tell us? First, you know what we got to do? We got to break out the old hedge fund playbook to see what works in this environment and recognize that this market has some newfound hazards that could make us course correct from usual playbook design. For instance, we know the drug stocks go hand in hand with utilities, but there are plenty of drug companies that aren't doing well. So we got to be a little more selective than usual. For example, normally at this point in the business cycle, I tell you to go buy Bristol Myers, the quintessential slowdown stock. But Bristol Myers doesn't have enough in the pipeline right now. So The drug company with the best pipeline is Merck, with an amazing array of anti-cancer, immunology, and cardio drugs. Hey, look, or you can say don't overthink it. How about Pfizer? Yield almost 6%, host of new drugs, or just go with what's really working this year. Eli Lilly, because of the weight loss wonder drug. Or do what we did today with the charitable trust. I mean, follow it along by joining the CNBC Investing Club. We bought some Abbott Labs, dividend aristocrats being crushed, dropping from 121 in March, 105, despite a terrific quarter 3 weeks ago, because a competitor in the infant formula business, that's one of their lines of business, they lost a lawsuit badly in the death of a baby. It's a rare occurrence, but now it's got Abbott shareholders running scared like it's J&J or something, where they got a litigation morass. In the old days, you could buy pretty much any food stock at this point, but the arrival of these GLP-1 weight loss drugs has thrown that group into a tizzy. We know these drugs reduce cravings, but we can't be sure which one it reduces. Neither Coca-Cola nor PepsiCo have seen any degradation, though. They've told me that. And there seems to be a long way to choose, just my version, my view, between these two in the carbonated aisle. PepsiCo, which has Frito-Lay, which conceivably could be hurt by GLP-1, got these small form factor bags, selling very well. Beyond the traditional slowdown stocks, there's something else we noticed today. If you have a theme that can outrun the utility leadership, that money will crowd into it. Now, we know one. It's the data center. These warehouses of servers are being put up everywhere, something we've seen practically every day. Last time we got word from Arista Networks, one of my favorite companies, one of the best makers of networking equipment that links NVIDIA chips to where the knowledge needs to go. Arista's business is growing nonstop, and that also ignited Broadcom, a competitor, and also a charitable trust name. Meta took off. Alpha and Amazon stayed still. Apple's been good, too. The group can be fractious and unruly. Tonight, ARM reported, and the semiconductor light company gave us a weaker outlook than expected, so the stock's down a lot, but I'm not sure it's going to stay down. Oddly, there's one other group that's playing on razor's edge. It's the banks. In theory, they do well if rates stay higher for longer, but they also have fewer credit problems if rates come down. The financials are fickle, though. Be careful. As we know from the stocks of Upstart and Affirm, two fintech companies with stocks that got obliterated today. I will have Affirm on later in the show. But then JP Morgan vaulted 2%. I'll take that sweet move. When in doubt, I say stick with what's worked in the past when the Utes soared, not necessarily what's working at the very moment. But the bottom line, at the end of the day, the Utes, they never lie. When they're rallying this steadily, these stocks are screaming that Jay Powell may have gotten the ball rolling for that slowdown simply by warning us that he's not going to prevent one as long as inflation stays high. Yet Powell called it simply by saying the rate cuts are on hold, causing anyone who's holding out for better times to throw in the towel. And when you take the utilities higher, you're throwing in the towel for certain. How about we go to Alex in Pennsylvania? Alex.
Hey, Jim, how's it going? I just want to say I love your show, and I'm from your neck of the woods out here in Ballackinwood, PA.
Ballackinwood, some people who are ill-informed call it Sinwood, and we have to correct them. You know, it's a Welsh name. People don't know that either, but I got that all in my head. How can I help?
Hey, Intel, what's your take? I mean, here, Biden...
Okay, I'm going to tell you something. Just stop right there, because you're a Philadelphia. I'm from Nana Mary, a true Philadelphian from the north side, always said one thing. Nana Mary said, if you don't have anything good to say about something, then don't say it. Nana Mary says, I ain't talking Intel. Let's go to Rebecca in New York. Rebecca.
Hi, Mr. Cramer. I want to thank you so much for talking to my grandson, Arya, yesterday.
That kid's got horse sense. I like that. It really got a good rap.
Well, I think he got it from me because we watch his show practically every night together. And I try to explain everything to him.
I knew it had to come from somebody.
Oh, you are so sweet.
Okay, that's me.
I wanted to ask you about American Eagle. And they were doing well, then I see it just going south. What do you think?
You know what? They have the hot stuff. The problem here, Grandma, is this. When you get to the hot stuff, you got to get in and you got to get out. That's too hard for me, too hard for you. Let's go with more traditional. Let's go with something like a Walmart or my favorite, and yours, no doubt, Costco. That's what we're going to go with. And the kid stays in the picture. Look, at the end of the day, the Utes never lie. And when they're rallying like they are like now, house of fire, you got to prepare for a slowdown. Mad tonight. There's been a lot of talk about a slowdown with the consumer. So are they staying away from the Dutch bros? Or is that bucking the trend? I'm going to speak to the CEO. That Affirm reported a really terrific quarter. So why are investors selling this buy now, pay later name? Maybe they're wrong. And if you wait on the Fed to cut the rates, well, you might want to add at least one REIT to your portfolio. I'm checking with Federal Realty, which is a shopping center, don't call it a mall, to learn about the latest in the space. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
What the heck just happened to stock of Affirm Holdings, the buy now, pay later fintech platform? This morning, Affirm reported a seemingly excellent quarter. Terrific gross merchandise volume, that's a key measure. Terrific revenue, terrific margin. Credit quality looked real good, too. And the company issued better than expected guidance across the board for the current quarter. Yet after initially roaring higher, the stock reversed within the first half hour of trading, then continued to go lower throughout the day. Finished the session down at a kind of extraordinary 9.5%. The most frequently heard explanation, we're told Affirm was down in sympathy with Shopify, the e-commerce technology play that's one of their major partners. Sure, Shopify gave a not-so-hot forecast. We went over that. But we just heard great things from Affirm today. The alibi, insane. Don't take it from me. Earlier today, we got a chance to kick the tires on this one with Max Levchin. He's the brilliant founder, chairman, and CEO of Affirm. Take a look. That's a remarkable quarter because you've got a situation where you're growing, you're predicting even more growth, your bad loans going down. To me, this is what I regard as a halcyon moment for Affirm.
I agree. I think we've done really well. Thank you.
But we're going to have to deal with the fact that the stock's down. But I don't want to do that until you tell me, in your words, how rare that combination is. Because I've seen people accelerate loans, but usually then we have more bad loans. I've seen people hold back when they feel that the rates are too high. I'm not getting any of that from Affirm.
No, we are growing really well and managing credit as carefully as we ever have, and have no intention of compromising on either. In fact, the moment, I think, really shows that our credit diligence and care is decoupled from our ability to grow. We're not trading one off for the other. We are probably yielding or earning a little bit more than even we expected, and so we intend to reinvest that extra money into growth, not necessarily by taking more risk, just by finding more ways of attracting customers, but we are not correlating growth and credit deterioration at all.
But you have said that you're willing to go a little bit lower on the economic risk, meaning people having little less money, because you're doing so well and because your data demonstrates that you don't seem to make bad loans when you extend credit to people who might otherwise not know what they're doing.
Not necessarily. One of the things that we can do with the over-earning is actually subsidize more APRs, which works really better for folks at a higher credit spectrum. Those that like to use Affirm who don't really need Affirm, which of course the best loan you want to write is the one to someone who doesn't necessarily have to borrow money, the ones that really appreciate APR subsidies. In the world of 5% Fed rates, seeing a 0% APR, which in our case means no compounding, no late fees, no flip where your APR suddenly changes to a number you didn't recognize. We never do those things. And so 0 APR loans that we write are an extraordinary deal, certainly in today's environment. So we'll invest some of the money that we earn into creating more of those opportunities for our borrowers.
Million credit cards. So far, it looks like that you don't need to charge. You do praise Capital One. I thought it was good because it's another way to make money. Mr. Fairbanks created another way to make money. It's not your way. But it looks like that your way is good for a little better for the person who has the card and seems to be making a lot of money for you anyway.
Not for me to judge other products. I have a very strong point of view on what works and what doesn't for Affirm. Our card is not a credit card. It's its previous name was Debit Plus. It's a better debit card with a borrowing capacity built into it. It does have 1 million users. It is gaining traction with that community of users. We are increasing their annual usage of the card. So the card is doing really well. We still have an extraordinary amount of features we want to build into the card. I would think of it as now maybe slightly better than a beta product, but it still has a lot of room to grow through creation of new features. Okay.
Now, until very recently, we had innocence by association. If one bank did well, another bank did well. Then the Fed decided to keep things higher for longer, and suddenly it's the other way. You have a partner, Shopify. I interviewed Harley Finkelstein, whom I've interviewed many times, I don't know, for a decade. And he did make one little change, a 0.5 gross margin, and it was because, frankly, there were some businesses, you could say, gross margin. Let's say the general merchandise is come down a little bit, but it's really slight. And your company's stock went down quite sharply after Harley outlined that on Squawk on the Street today. The correlation to me, while not fatuous, seems a little overdone.
If I could predict the market, I'd probably have a different job. I'm just very focused on running the company that I'm running.
Well, but I'm focused on the people who own the stock, who today are not as rich as they were yesterday.
I agree. And I am just as motivated as they are to make sure our stock over a long period of time gets to dizzying heights that I think we rightly deserve. For the record, I have never sold a single share of the company I founded and remain a very proud holder. We are partnered with Shopify. It is I have a lot of favorite partners, but maybe Toby and Harley are my favorite partners because they've been extraordinarily supportive, and we've done a lot of things together and intend to do a lot more things together. Today's market reaction is today's market reaction. I take market temperature every quarter or two, and we'll get there.
You had been associated with Peloton. We can take that temperature, and that temperature seems to be a little bit more on the rigor mortis side than it does see on the 98.6. But again, I don't want to extrapolate. You have your own business. I understand that, and you've said that. So by my putting it up, in some ways, I'm putting up a trial balloon that is not being shot down by you, and yet I would feel more comfortable if it were, because I don't see Peloton being Affirm. I think that that's an abstraction.
That's entirely right. I didn't mean to laugh it off at all. So Shopify is an extraordinarily important partner. We have many partners. The business is very well diversified. Peloton, when we went public, in the disclosures, it said 26% of our business comes from Peloton. At this point, we don't have to disclose it because it's well south of 1%.
Right.
We've grown tremendously since our IPO. We've grown tremendously even in the last year, as you saw, another great quarter of growth. So we are not dependent on any one major or minor partner, and we do have a great business. Moreover, we have a direct-to-consumer business that is entirely independent of any merchant partners. The million cards we have are transacting because people are pulling them out of their pocket as they walk into a store, as opposed to a store flagging them and saying, hey, please use Affirm. So we feel very well diversified. What the market does is not for me to comment.
True. I mean, that's kind of where I'm going, because I could have started the interview by saying, hey, you know what? You have Amazon and Walmart. Those are the two best. And I happen to know that both of them, as of the last few weeks, are doing incredibly well. So therefore, Affirm must be doing well. That is equally as fatuous. What matters is Affirm doing well versus what Max wants. And you seem to be content. And I know that you have been hard on yourself if it's not right. This seems to be one of those moments where you, while never contented, because you are an aggressive guy, you feel that you can put some more gas, press down on the pedal.
Absolutely. For the avoidance of doubt, I think the market has it wrong today. I think the market reaction is entirely misjudged. That said, it is not, I don't control Mr. Market. Mr. Market controls itself.
True.
That said, we are in a great position. Right. From the capital markets point of view, probably the best we've ever been. From the product development point of view, extraordinary, and yet I can see, as far as the engineering roadmap will let me, things to build and things to ship and things to delight our customers.
Gross merchandise for you, maybe exactly. the best ever. Not maybe, but the. Okay, now, some companies are having, in similar industry, but again, not to extrapolate to you, funding issues. To me, it seems like your strong credit metrics are making it so funding is obviously not only not an issue, but you got to figure out how much you want to use.
The best way to manage our capital markets partnerships is to continue delivering great yields and making sure that they see that we are in control of risk. Part of why every quarter we say, hey, we are in control of credit, is because we know our extraordinary position in capital markets is very much a function of the results we've delivered. And so we intend to keep both eyes on credit at all times, but we're done really well. We'll continue to do really well. We're doing great as of today, and our capital market state of things is singular relative to the rest of the industry.
All right, now let's talk ethos, which is what I wanted to get to before the stock was down. You have been probably the foremost figure for democracy and credit. And you said from the first time you were on that you believe that your metrics are such and the work that you've done that democracy would succeed. At this point, we can make a judgment that it has so far succeeded through many different kinds of interest rate increases, including maybe one of the harshest cycles we've ever had. I have to presume that this is a model that we can declare victory on as being the right one.
Again, I think it's dangerous to declare victory in a rapidly moving field.
True.
But the proof point is exactly as you said. In the world of ZIRP, everyone is a credit underwriter par excellence, printing lots of loans and feeling great about themselves. In the world of 5% rates, I think the reports of our death were greatly exaggerated.
Right.
Thank you very much. And with a 30+% GMV growth and 50+% revenue growth, we seem to be doing just fine, independent of the rates.
Well, okay, until I had always thought that the way to do it your way was you had to do it 15%, 17% to make up for all the so-called deadbeats. That turned out to be wrong.
I think, and we can debate this one on air, off, there is the right price for every credit risk. The thing that's really, really dangerous is when you start paving over sloppy decisioning, bad underwriting, or lack of discipline just by pricing it all in and pushing it onto the consumer. There are people who are great people, they want to pay your bills on time, but bad things happen to them. Maybe because they don't have a steady job, maybe because they experience some sort of a health disruption. You can find the right price for them. It's essential, in my opinion, that you're transparent, that you don't kick them when they're down. So when they cannot make the bill, you don't tell them, aha, great news, we're gonna charge you some late fees, we're gonna heap some incremental compounding interest on you. We don't do any of that for the reason that we want to keep their business, we want to keep their faith. And so I think our model works really well from zero on APRs. Right. And that's what we set out to prove, and it's been 13 years and counting.
Well, I can just tell you that there are a lot of people who counted you out. I say that when the stock is down like it is today, you buy. And that's proven to be a very good call. Max Levchin, founder, chairman, CEO of Affirm. And you see, I made that judgment. I didn't make you do that judgment.
You can say it.
It's my job. Thank you.
Coming up, the market that loves a motor mouth? Cramer explains why some stocks sink or swim on CEO guidance. Next.
The guidance is the guidance, and you always have to wait and see how it plays out.
That's what the legendary Frank Slootman, one of the most successful businessmen on earth, told me when he wanted to explain why I was wrong to overweight Snowflake's forecast as a way to value the stock. That was all the way back in November 2022. As he saw it, the forecast is just a number, and in a skittish market, that number can have a lot more impact than it should. Welcome back to a very skittish market, one where investors aren't interested in how you did. They only care about what you say you'll do in the future. So if you aren't offering a healthy, sharply better than expected forecast, well, your stock is instant roadkill. This morning, Harley Finkelstein, president of Shopify, came on Squawk on the Street, told us not to worry about his guidance, which calls for a slight degradation in gross margin after a truly blowout quarter. Does that make sense? Depends. The CFO, Jeff Hoffmeister, explained on the conference call that Shopify's expected 50 basis point gross margin decline largely comes down to, and I'm going to quote here, the expected growth of our lower margin payments business and lower revenue contribution from a high margin non-cash partnership that will have fully amortized, end quote. To me, that's a hangnail, barely worth noticing. To the market, though, it was a disaster that caused Shopify to lose nearly 20% of its value in a single session. Uber reported a fantastic quarter, showing strength across the board, but for some attenuated reason. Management guided for gross bookings of $38.75 billion to $40.25 billion, ever so slightly weaker than expected. That was enough to knock almost 6% off the stock. Kind of ridiculous given how hard it was to figure out why Uber even gave such a cautious forecast. But Slootman's law. The guidance is the guidance. So management must know something or they wouldn't be so circumspect, or at least that's how Wall Street sees it. We saw the same thing with Upstart, the artificial intelligence-based lender that used to be a market darling before the stock peaked at the end of 2021. Upstart had a terrific quarter, but the outlook was suboptimal and the stock dropped 5.5%. Is that fair? Look, it's just a number. But the number means something in a market that's sensing a slowdown. It's not just today. Datadog, a truly terrific enterprise software company that does digital infrastructure monitoring analytics, saw its stock fall from 127 to 112 yesterday because, well, its second quarter earnings guidance was a penny short. Stock rebounded 117 today as cooler heads prevailed, but it's still way down from its pre-quarter highs. But you know what didn't bounce back today? Disney. Now, here's a company that reported a terrific quarter yesterday. In a vacuum, it would have sent the stock much higher. However, there's no such thing as a vacuum on Wall Street. Disney CFO Hugh Johnston gave us a Frank Slootman bomb of a forecast quote, as it relates to demand, while consumers continue to travel in record numbers, hey, so far so good, and we are still seeing healthy demand, I don't like that word still, we are seeing some evidence of a global moderation from peak post-COVID travel. That's what took Disney from 116 to 105 yesterday. No real rebound today. Now, there are times when I think we need to take all these forecasts with a grain of salt. If the Fed starts cutting rates, I could see buying some of these stocks, although they're not the first ones I'd reach for in that scenario. I would prefer to go, say, for a builder's first source, a home building supplier with a stock that fell 19% yesterday on soft guidance. That one should react immediately to a rate cut. But either way, you need to understand in this market, even though the guidance is just the guidance, right now, the guidance is all that matters. Mad Money's back after the break. We had a lot of big breakdowns today. We also had some extraordinary rallies. Take Dutch Bros, Oregon-based coffee chain, reported a blowout quarter last night. Company earned 8 cents per share. Wall Street was only expecting to break even. Higher than expected revenues. Get this, 10% same-store sales growth versus the 4% the analysts were looking for. This was driven by both higher price and, crucially, higher traffic. Not many companies can raise prices without driving away customers, but Dutch Bros just did it. No wonder the stock shot up 12% today. That said, still flat for the year, so maybe you got a chance here. Let's check in with Christine Barone. She's the new president and CEO of Dutch Bros to get a better read on the quarter. What's next? Ms. Barone, welcome to Mad Money.
Thank you so much for having me, Jim.
Well,
I brought you an iced protein milk annihilator.
Well, you know, I can't resist. Is there any way I can break through the 3 dimensions of this and have my absolute favorite drink from when my daughter lived in Oregon? Thank you for coming on the show, and thank you for knowing my drink. I want to ask you, first of all, these are spectacular numbers. There's some other high-profile chains that did not deliver, including Starbucks. I know you're not going to knock the Starbucks, but they had low single-digit declines. How can you explain your 10% comp versus the King, which had low single-digit?
Well, I think if you look at our quarter, we were really performing on all cylinders. So we were driving innovation. We launched protein milk coffee in the quarter. We launched boba in the quarter, which were both hugely successful. We grew our awareness with paid media. And we were also super focused on our rewards program. And so our customers who come in a lot came in even more.
All right, so how do you deal with the lines? I would imagine that is the single biggest problem, especially if you're going to go mobile order, which you're trialing.
Absolutely. So what we focus on is speed, quality, and service for our customers and with our broistas. And so speed is absolutely something that we're always focused on, helping our customers get through the lines faster, but they still love to have that awesome conversation with our broistas.
Well, it is fun, I have to admit. Now, let me ask you, I want people to understand the scope of what a real growth story is. A growth story is a company who's accelerating comps, making more money, that is in a certain number of states where it's clearly proven of concept. It can be anywhere. How many Dutch Bros could we have in the United States?
Well, we are on the path to 4,000 Dutch Bros. We hit 876 this quarter, and we just opened our first 2 shops in Florida. So we are now in 17 states.
Now, when I think of that, why does everything work in every state? We know that there are some companies that are just regional companies. These drinks seem to resonate. Your new drinks are resonating everywhere in the country, correct?
Absolutely.
Well, I've got to tell you, the one thing that I thought, I was looking at the prices, it's not necessarily cheap. I mean, you've got a small $3.95, and that is well under Starbucks. But when I get my large, when I get my 32 ounce, it's not inexpensive. Will people pay up to, say, $6 for a 5 1/4 drink now?
I think what customers are coming in for is they're coming in for the experience. And so they're balancing what they're paying with what they're getting. And I think when you come to a Dutch Bros, it's not just about the beverage. It's really about the service and that conversation you're having with us.
Now, let me ask you, do you do, we had a fellow, Oz the Mentalist, comes on. I love him. He knows everybody's name. How did people remember my name and a little nothing? Well, no, Ashland's a nice town. But how did people remember my name and 2 different ones who never watched cable and knew my daughter's name? Is there some trick to knowing people's names like your people do?
It's actually not a trick. It's actually really authentic. We hire people that really want to connect with others, and that comes directly from our broistas. It's not something that comes from training. It comes from hiring awesome people.
Well, okay, so you hire awesome people in Florida. How do you find them? I mean, what is the way you can keep great managers in the pipeline there? And how do you find these great people? Because it is not, other chains are having and struggling to find the right people.
So it all starts with how we grow. So we only grow as we're ready to have people who are ready to go into these new markets and open new shops. So we have our operators that move from all over the country to our new markets to introduce Dutch Bros to these new markets. They move into a new market, they introduce the brand. We bring our mob, which is our group of trainers, to a new market, and they really light our stores up, turn it into a party, and do such an incredible job in training new employees on all of our beverages and our service.
Well, it is a show, and I wanted to ask you a question. A long time ago, Home Depot wasn't in New York, and then this is when I was a hedge fund manager. They opened one in Elmont, Long Island, and I told Karen Cramer that when they open in New York, you're going to catch a double. When are you going to open in New York, Dutch Bros?
All right, well, we're coming one day. But today we're really focused on Florida, we're focused on Texas, we're focused on Tennessee, and then starting to move up the East Coast.
All right. Now, are you going to go, how many are going to be parking lot Dutch Bros and how many are going to be these build-out Dutch Bros?
So we're really focused on building out drive-through locations. And with that, we do have parking spaces within our drive-thrus, which should be quite helpful as we roll out mobile order and pay.
And are you averaging 2 million a unit all over the country?
We shared that our average unit volumes for the quarter were $2 million.
But that's extraordinary. I mean, it is very hard to get to that level. It took Chipotle forever to get there. And this is just coffee.
Well, we've been doing this since 1992 and for 30 years. And I think have worked on a lot of things to get this right.
Now, give me your background, because you did just take over. We knew previous management from the day that it came public. What is your connection with Dutch Bros?
So I joined Dutch Bros 15 months ago, and I am just thrilled to be a part of this team. I love going into our shops, making drinks with our broistas, and I just see such incredible potential for what we can do in this country. I love being a part of a brand that is growing so quickly and really growing in the right way through our people.
Well, look, I've been sold for a long time, and I'm glad that you're on board. That is Christine Baroni. She's the president and CEO of Dutch Bros. BROS. Guys, you haven't missed anything. This stock, I really think, could be a rocket. Thank you, Christine. So glad you came on the show.
Thank you so much.
Money's back after the break.
When we return, master the markets one stock at a time. The lightning round is up next.
It is time. It's time for the lightning round. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. I want to start with Jeff in California. Jeff.
Booyah, Jimmy Chill. We love you. Hey, Jimmy,
you,
just a really quick question.
Sure.
Do I chill out like the Chill Master would do, or do I freak out? Net or Cloudflare fell over 13% a couple days ago, which was unexpected. And I'm just wondering if this is still a great company and should I buy more?
All right, so Chillman looked at that quarter several times, read the conference call. Don't think Matthew Prince has lost his charm. I say you buy right here. Let's go to Darcy in Illinois. Darcy.
Cramer.
Yeah. Booyah.
Hey, curious to get your thoughts on Cognex, CGNX.
You know, niche company, niche Massachusetts company, Machine Vision. I kind of like it. Makes money. You know what? I mean, look, is it going to catch on fire? It's actually kind of caught on fire, but I like it. Let's go to George in New York. George.
Yes, Jim. Hi.
How you doing?
Great. Love your show.
Thank you.
Question. I want to know what you think of what this private equity executive, Pete Stavros at KKR, is doing, offering employee ownership.
Well, look, I'll tell you this about KKR. I mean, they and Blackstone have been winners. I like them very much. I typically don't like to recommend these companies because I don't know what they own. But sometimes you just have to take the pedigree and realize they've been so good for so long, you got to go with the flow. Now I'm going to Dave in Illinois. Dave.
Dr. Cramer, my mad tuna fisherman friend, how are you?
Oh, man, I'm bringing in the big ones. 80 pounds. Took many hours of fighting. What's going on, Dave?
Sounds good. This $66 billion company provides water and hygiene solutions and services. Ecolab Inc. has delivered upside surprises every quarter for the last 2 years. Seems to me to be a solid performer. Jim, your thoughts on
Oh,
EPL?
my Ecolab, haven't been a customer of theirs. I mean, they just clean up. You got to be. Hey, I'm going to give Dave a twofer. Why not give Dave a twofer? He calls, he's always good. I'm throwing in Cintas. I'm giving you Ecolab and Cintas, kings of the small business world. Let's go to Tyler in California. Tyler.
Big Booyah from California. How you doing, Jim?
I am doing well. How about all you guys?
We're doing great, thank you.
All right.
With Congress approving Russian uranium bans and CEO and other insiders buying, what's your take on uranium, especially you?
Well, that's not been the one that I have been recommending. So let me do some more work, because the one that I've been stuck on is Uranium Energy Corp, UEC, because it makes money. That'd be my fave, but I'll come back with a little just because I like the symbol. Let's go to Carrie in New Mexico. Carrie.
Hey, Jim. Hey, what's Jimmy Chill's recommendation for Astera Labs?
Too high. I just think too high. Let that one come in. Too new, too high. Bruce in Idaho. Bruce.
Hi, Jim. Booyah.
Booyah, Bruce. What's happening?
Yeah, I've been listening for many years, getting your valuable input, Jim. My question involves AI on the edge. We know Apple's focusing there, and so is my former hometown San Diego company, Qualcomm. Qualcomm jumped big after earnings and is approaching an all-time high. Where's your view on Qualcomm's future and its stock currently? Thanks, Jim, for everything.
Okay, I need you to read through my piece that I wrote on Sunday for club members. You got to read it, where I said my mea culpa Qualcomm. May I suggest that is required reading for everybody. Join the club. And that, ladies and gentlemen, including of the Lightning Round!
The Lightning Round is sponsored by Charles Schwab. Coming up, can summer sunshine power the outdoor gems in this real estate trust's crown of properties? Cramer makes a federal case out of it. Next.
As we see more brown shoots, more signs of a slowing economy, it becomes more likely that the Fed will cut interest rates, and if rates are headed lower, well, you might want to consider owning a real estate investment trust. Take Federal Realty, long our fave, which owns lots of mixed-use properties, primarily in rich suburbs. This is an incredibly consistent operator, even during the toughest times, the toughest. It caters to high-end tenants, which are holding up much better than low-end retailers. Now, last Thursday, Federal Realty reported a solid quarter with inline funds from operations. The real estate, it's the equivalent of earnings. And talk about excellent leasing activity. Wow. Everything's pretty much filled. The stock initially got dinged. People don't understand how this company works. Don't take it from me. Let's go straight to the source with Don Wood, the CEO of Federal Realty Investment Trust. Mr. Wood, welcome back to me, buddy.
Jim, it's great to be here. Thanks for having me, man.
Don, when I read through it, was just a classic Federal Realty call. You've got almost no vacancies. Where you have vacancies, you're obviously going to make more money than you were. It's just a consistent moment for you.
It's about being consistent, and the question of, do demographics matter? Because I'm not sure they mattered all that much coming out of the pandemic. Right. There was an awful lot of government stimulus. There was an awful lot of artificial things after you lock people up for a while to have them come out and spend and stuff. Now we're in a period that's post that I think is more normal,
right,
if you will. And I actually feel very good about the future. Let's see what happens, but we're in real good shape.
Okay, but you also make a point. Look, there are outfits that are not doing Express. You said Big Lots, Joann's, Family Dollar, which is interesting because they have to close a lot. But they're not yours. That's not who I find at Federal Realty.
Yeah, let's talk about inflation for a second.
Yes, let's do that.
Inflation is not an equal opportunity effector.
Okay.
Just about everything that you spend money on today, that I spend money on today, that everybody does, is 30% more than it cost in 2019 or something, right? So if you're that retailer whoever the retailer is. Your labor is up higher, your cost of goods are up higher, your interest costs, your money cost is certainly up higher. The question is, are you able to pass that on to the consumer?
And you say point blank that your people can.
That's the difference, and that's why I really do think it's a big difference, because the companies you're talking about there cater to a lower-end customer. Not a bad thing, just a tougher thing if you're trying to produce consistent results through ups and through downs in a cyclical, economy.
I think the term shopping center, I know we have to use that. It's not shopping mall, but shopping center does not define Bala Cynwyd, where my father's from, and it does not define Santana Row, where my fabulous producer, Regina Gilligan, and I recently had a couple of margies.
I hope.
No, never. But what I wanted, but people have to understand is when I'm sitting there, I'm looking at office, I'm looking at residence. This is not your grandparents' shopping center.
No, this isn't. These are communities. These are neighborhoods. These are the realization that outside of the central business districts of America's best cities, there are suburbs that are close in that can provide the entire experience for consumers who today especially work from home, and after COVID, they don't want to sit in traffic. They don't want it. They want the amenities that they could get in the city. They want to be able to live in a really nice place close to where they work, in some cases with mass transportation when that's there, and have it all. And today you can have it all in select locations.
Well, I want people to understand this is not a sales pitch by Don Wood. If you go to one of these, what you realize is they are coveted. The retailers covet, the residents covet, the office company, like a Cisco, which is replacing Splunk, they covet it.
Yeah, there's no doubt that when you have a place like this, first of all, they're expensive to build. They're expensive to do. So they have to draw from more than 2 or 3 or 4 or 5 miles. They have to draw from larger areas. And when you have a more regional location like that, it also allows you a much broader palette of tenants that you can bring in, both especially on the retail side, because I'm a retail guy. We are a retail company through and through. The idea is to make that ground floor as exciting as it possibly can. Then you can talk about living there or working there or staying in a hotel there.
But Don, you mentioned this is not the time for you. You're not starting some new big projects.
No. Listen, every part of real estate has its cycles, and there are times when it's better to build stuff, and there are times when it's better to buy stuff.
And to sell some stuff. You've got, $400 million on that you're willing to part with.
Certainly to sell some stuff in order to buy more raw material. Because what we like to do is take undermanaged shopping centers and take shopping centers that haven't been invested in, if you will, for the last 20 or 30 years, because then we can work our magic. That's what I love to do, and that's our company's really good at it.
No, we had Tanger on. I know you like those guys. They're looking at the Huntsville and the Asheville and the Nashville, the Bills, but you're really a coastal guy.
Well, yes and no. I do think that COVID has changed that a little bit.
Okay.
I do think there are certain markets that are better. I was just on a panel today with Steve Yeloff of Tanger.
He's a fun guy.
I think, and I said to him then, and I'd say it again here, I think he did a great job buying Huntsville. It was a bit too small of a market for us. We looked at it. But for what he and that team is trying to do, I think they're doing a great job. This is my commercial for.
No, I know. You're a great spokesperson for your industry. You got me even to see David Simon from Simon Property. You also had a good quarter. Gotta like man. David. He's a good man. But anyway, that's Don Wood, who's the CEO of Federal Realty Investment Trust. And I can be as ebullient as I like. Why? Because he's made money for us even during the down days. I like to say there's always bull market. Some of my promise I've had it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. This call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.